We're seeing an AI-related stocks meltdown pretty much across global markets today. Could India come out unscathed if the bubble bursts, given that foreign investors have been fairly down on India this year?
Well, Has, that's a really interesting question. And let me put it in the shortest possible answer that I can give you. Yes, India could potentially be a beneficiary. And we've seen what is called the AI hedge trade already play out in a wee bit in India's favor, because really India has absolutely no AI play to boast of. Now, this country will definitely be one of the world's biggest consumers of AI, but so far we have no hyperscaler stocks and no significant data center capacity stocks to talk about. So yes, if there is a burst in the AI bubble, there's a good chance that people will look for growth elsewhere in the world, and India potentially presents that opportunity. And in fact, that allows me to talk to you about, Neelkant Mishra, who joined us at Bloomberg's first subscriber event. Now, most of us think that, it's been a terrible year for India, what with Trump's tariffs, the US trade deal still pending, China hostility, middling growth. But Neelkant Mishra disagrees. He says, in fact, and I quote Has, the real story of India this year is how the reversal of monetary tightening and the end of hard fiscal tightening is driving a cyclical recovery in the economy. Mishra is the chief economist of Axis Bank and also a part-time member in the Prime Minister's Economic Advisory Council. Listen in to what he had to say.
I've been expecting this time correction for a while.
How long will it continue? Since you got it right with the expectation.
So you get it wrong, you get it right in market forecast, you hit and miss. So, but I think that in the next 12 months, the 12-month forward earnings will start to rise because as the economic recovery comes in. Remember that in the last 12 months, India is among the worst markets in terms of earnings revisions. So we saw a 12% cut in earnings, which is among the worst in large markets. And as a result, the market remained stagnant. Everyone else went up 20%. We were still stagnant. Then our weights in various benchmarks fell. A lot of passive funds had to then pull out of India. So all of that has happened, but that's behind us. As the economic recovery starts to come in, and when I was in the US and UK meeting investors, I was shocked to see that the short-term investors were calling India an AI loser and Taiwan and Korea the AI winner, and therefore, India is a funding short, that, you short, you get the money and you invest somewhere else. And so I think that will start to change as the roots of the economic recovery start to show up, or at least the momentum becomes more visible, and people realize that the improvement in October and so far in November was not just because of GST and it's going to last. As that starts to become more convincing, I think foreigners, at least on a relative basis, will start to come back.
All right, so Mishra is anticipating more than 7% growth, and one of the biggest beneficiaries of a fast-growing economy is the country's financial services industry. Joining us this morning, Jairam Sridharan, Managing Director and CEO at Piramal Finance. Jairam, thanks very much for being on Bloomberg. Your industry is being buffeted by two big changes. One is a revival in growth, and therefore a revival in credit growth, and then a surge in deal activity, especially foreign investment, and potentially the merger of small public sector banks. Which one is the most significant trend according to you, and how do you see it play out?
Good morning. Thanks for having me, Menaka. As always, fundamentals trump deal activity. So what's fundamentally happening in the economy in terms of growth, credit build out, market structure is always going to trump the kind of, we are excited about the deal activity, don't get me wrong. There's a lot of interesting things happening, and certainly long-term investors seem to have discovered India as a potential source for deep investing. And that's a great thing. But but the fundamental growth in the economy, I saw Neil Kant speaking a little bit earlier in your piece about kind of earnings growth that he expects to start seeing. And I fully agree with the points that he was making, that when you see the fundamentals of the economy, and when the economy, goes back to chugging along at 7.5%, that is always going to drive credit. Over the last 50 years, lending in India has grown at a nominal rate of 15.5% annualized over a 50-year period. That's an incredibly long period for mid-teen growth to be maintained. And however, in the last few years, the last 10 years, that rate has come down to about 11%. So nominal growth coming back, and that resulting in greater credit growth is always going to drive our sector a whole lot more than the deal activity.
Yeah. Jairam, can you talk us through what specifically you expect over the next 6 months to 1 year, and which pockets of the economy you expect some of this growth to come from? Is it retail lending? Is it lending to small enterprises?
See, if you look at the Indian economy over the last few years, there have fundamentally been two main engines that have driven the economy. On the one hand, there is government spending, and on the other hand, there is personal consumption expenditure. Those are the two engines which have actually driven the economy a lot. What has happened over the last year or so is government spending as an engine slowed down, starting from just before the elections, the general elections, and then the election results coming up with slightly surprising and soft results on the present government, and then them having to try to find their own feet, etc. So over the last calendar year, there was a 6, 8, 9 month period in which you saw government spending go soft. And that meant of the two engines that the economy is working on, one of them has gone soft. And that was creating some problems for the industry. That has now started coming roaring back. And that's always going to be a great thing for the economy. Consumption is patchy, and we're seeing some pockets of softness in rural India, etc. But mid-market India is doing really well. Both the large cities and rural India are probably kind of still a bit soft, but middle market India is doing really well, and we are seeing a lot of pickup there. You've seen some of the activity that's gone on recently in terms of car sales.
Right.
That shows you that consumption and that ability to invest small ticket capital expenditure on the part of the household is very much back.
Jairam, you talked about this massive growth. I don't want to be a party pooper, but could lenders be underestimating credit risk on the back of that?
If anything, Haslinda, I feel lenders have been over the last year overly cautious. I think the country did go through a little bit of a credit risk jolt in the middle of last year. And what that did is a whole lot of people pulling their hands back, a whole lot of lenders bringing down lending. The sector level kind of lending growth has come off starkly, particularly in unsecured credit, in personal loans, small business loans, etc. Things have come off pretty starkly, and in fact, in some of those sectors, YOY growth has turned negative. And this is a reaction to what I was saying before, which is government spending slowdown and resultant increase in credit risk that the sector saw. Everybody reacted very, very quickly, and that's also leading to a very soft sectoral credit growth right now. If you see credit growth as of today in the country, that it's running at about 10%. For a country where currently nominal growth is also about 10%, which means a credit growth to GDP growth ratio of 1:1. Historically, this has been 1.25 or 1.3:1 in India. In fact, in many developing economies, the argument made is that credit should grow at 1.5 times nominal GDP growth. But India currently is growing at 1x nominal GDP growth. That shows you the conservativeness that has seeped into the lending sector.
Jairam, speaking of optimism and excitement, we know that large foreign banks are getting really excited about the Indian financial services sector as well. What do you make of that trend? Is that likely to, continue? What do they bring to the table?
See, India is overall capital deficit. And in particular, we are deficit in long duration capital, long tenure capital. Indian capital expenditure is largely funded by banks, who themselves are largely funded by consumer deposits, which are 3-year tenor. And an argument that I often make is that you cannot build a 30-year country with 3-year deposits. That doesn't work. There is a complete mismatch here. So India needs longer gestation capital. Pension industry, insurance industry, etc. in India, which do tend to be long gestation capital, have generally been small compared to the needs of the economy. So, what are the sources of long duration capital that can get unlocked? There are two main ones. One is domestic promoter capital, a lot of which is locked up with domestic promoters, and two is international capital. The government clearly over the last year or so, working with the regulators, has chosen the latter. The government has said, you know what, we're going to find ways to attract long-term capital into the financial services sector to help us build this sector, which is kind of foundational for the rest of the economy, right? And to that extent, a lot of the approvals, a spate of which you have seen come over the last 6 months, are very welcome in that they are a form of a large ticket, extremely patient international capital entering into the foundational sector of financial services.
Jairam, but I'm sure that this will change the competitive landscape. Really, what kind of pressure does it put on the rest of the finance services industry like your company? And are you also looking for external investment?
So, India needs many more financial services providers, and we can deal with a whole lot more people coming in. It's little appreciated that over the last 10 years, the number of banks in India has gone down, not up. And that reduction in sort of competitive intensity is rarely spoken of. Why has it gone down? It has gone down because the government in particular has taken on a big charter of merging public sector banks. And where there used to be 25 public sector banks, there are currently 10 and probably will be lower number going into the future. And as that consolidation has been happening, that consolidated group has been losing market share, which shows you that competitive intensity is not increased a lot. India needs many more providers of credit and capital for the economy to continue growing.
That point is well taken. Jairam, are you looking at, or are any investors quoting you? Because I know there is significant heightened interest in the non-bank financial space as well.
Yeah, we are very popular right now, and we're getting a lot of interest.
You want to give us some names?
No, I'm afraid not. But it's it's a thing that is it's a trend that's very, very popular right now. We are one of the big large names that's out there, and we've kind of
if you can't give us a name of who's quoting you, give us a timeline for a deal announcement.
That's even harder. See, the way I'd say this is there are families of players that are showing interest, and it's similar to what you've seen recently. Large sovereigns, sovereign funds, long duration, pension capital. Asset classes or families like that, and of course, international banks who want to make a presence in lending in India. Those are the kinds of families of investors who are showing a lot of interest. At Piramal Finance, we are super well capitalized right now, and we are growing at upwards of 25% annualized. So we are quite happy where we are right now, and we'll let our current story play out a little bit more.